How's it going, everyone? It's Sam. Usually, every day, I sit down and do a market open video for the Patreon. Now, today, I'm doing something a little bit different. I'm going to be talking to you about why I bought a stock. And I actually plan on uploading this to YouTube, so if you're watching it from YouTube, great. You will get early access to this and videos every single day exclusively in the Patreon, kind of talking about what's happening in the market before I make videos on it. So if you want to join the Patreon, either HG Access or my own personal Patreon, there are links underneath the video. Otherwise, if you're from the Patreon, appreciate it. I think this will be good because it's a little bit different. While you're down there hitting subscribe as well, if you don't mind. You can also hit the link to Margex, where you can trade cryptocurrency on leverage if that's something that you're interested in. I actually opened up a Caspa long position yesterday, and I was a little bit careful with it. It went up a couple, like 5-6%. I put my stop loss right above where I even entered, so I got flushed out of this position, but I did have a very nice long on Bitcoin that went up 35%. So if you want to trade cryptocurrency, you can check out the link underneath the video. Now, if you're here for stocks, though, I bought a new stock today. It's called PayPal. You've probably heard of it. You've probably been interested in it, or someone that you've watched has been interested in it. And I finally bought it here. They had earnings, and they're down 8%. They're down 21% this year. And this is before this aftermarket, so they're going to be down like 27-28% after they open here today. And I want to tell you why I'm buying it and why I think that this could be one of the only really good values in the market today. We've seen, first of all, I should just hit on this. I don't even have a slide for this, but we've seen the S&P 500 hit all-time high, hit the new all-time high over the last 24 hours. We've seen the NASDAQ 100 put in new all-time highs. We've seen the Dow put in all-time highs. We've seen a lot of individual stocks obviously hitting all-time highs. If the indices are hitting all-time highs, a lot of tech stocks are running away in price, getting more expensive. And a lot of those are ones that I bought over the last couple of years. I bought a lot of Google. I bought a lot of Amazon. I do have a lot of Tesla. They're still down a decent amount from their all-time high. But I added positions like that have done extremely well. And I've added other companies that aren't as sexy, like Vici, Texas Roadhouse. I've added S&P 500. I also buy a lot of crypto as well that's done extremely well. But right now, there's just not a lot of deals in the stock market specifically. And I'll talk about how I weigh this versus crypto as well later. But I see PayPal as a good value right now. It's at a $68 billion market cap, and I think most people would agree that PayPal is pretty cheap right now. It's going to open up at like a $63 billion market cap or something like that. Most people agree that it's pretty cheap. The question is whether the business is a dying business or a growing business, because it gets priced very differently. If a company is continuing to grow at 10-20% a year, well, it's going to get a much higher price to earnings ratio. It's going to be priced a lot more expensively than something that is growing maybe 8% or 9% a year, and maybe they're even declining in revenue growth. However, PayPal doesn't seem to be declining anymore. And I think this is a big thing that Wall Street and maybe some real retail investors are viewing in the wrong way. So this is a very popular retail stock. A lot of retail investors watch this, and a lot of them have been buying over the last year, maybe 2 years, and they continue to see it kind of flounder sideways. Like over the last year, it is down 20%. Over the last 6 months, it's just sideways. And now they had another bad earnings. And a lot of people, I think, are getting a little bit discouraged. They see other stocks running away. But this company is actually performing pretty well. So let's take a look at what they did last quarter, because they just announced this last night. They had $1.48 adjusted earnings per share and $803 billion in revenue. Now, I like using this website. It's actually it's called Qualtrum. It's from another YouTube creator. I know that they haven't updated their quarterly numbers for PayPal yet, but you can just take a look here. This is a record-breaking quarter. From this year to last year, their revenue increased 9% over the quarter. This has beaten the record by about 9%, obviously, because the highest performing quarter before this was Q3, and it's very close to Q4 of last year. So they beat records in terms of revenue. They also beat records in terms of EPS. So the previous record was back in 2020, $1.34. Well, now they're at $1.48. Their net income was good. Their free cash flow was good. I believe they were at, let's see if I can find that in here. They had a record, no, they don't have it in here. They had a record quarter in terms of free cash flow as well, not just revenue, not just EPS, but also in terms of cash flow. So where does this come in where people are so negative about the stock? Why are people selling right now? Well, they provided guidance for the full year in the first quarter that fell short of expectations. The company anticipates full year earnings of $5.10 per share, below the $5.48 analyst estimates. So they're falling down. Basically, that's very similar to what they had this year. If I did the math right before, they had very similar EPS. So they think basically next year is going to be flat. Now, I looked at this and thought, wow, do I want to buy a company whose stock is just, or whose earnings are going to be flat for another year? Maybe this is a bad sign. Maybe they're not growing anymore. And in that case, I wouldn't want to buy the stock, even if it's at a cheap value, even if it's at an 11 or 10.5 price to earnings ratio. I don't like buying companies that are done growing. But the management team did say that this was a pretty cheap or a pretty conservative estimate for next year. So I looked into it a little bit more, and it is a newer management team. They probably don't want to set really high goals and then miss them. I mean, this stock is already down a lot. They'd rather just like take another punch right now and fall down even further and then beat next quarter or next year. And when I look at the past, they have not been disappointing. Over the last few quarters, let's just look up earnings here. Over the last few quarters, they've been beating. They've beat every time the revenue over the last 4 quarters. And 3 out of the 4 last quarters, they beat on EPS. And the only time they missed was by 0.3%. The times that they beat were by an average of maybe 7%, 6.5%. So they do perform pretty well compared to what they say they're going to do. And they're still growing right now. Like if you look, they grew by 9% in revenue last quarter, year over year. The quarter before that, it was 8%. And the quarter before that, it was 7%. So they went 7% growth, 8% growth, 9% growth. So they do seem to be re-accelerating their growth. Right now, they are free cash flow positive. They're still a profit machine. I mean, look at this free cash flow. It's $5.1 billion for 2022. I believe it's right around there for 2023. Let's see here. Yeah, so they had 1 quarter of negative free cash flow, so it might be a little bit below that. But they could still buy back a lot of shares, and that's what they're doing. You can see their shares outstanding are going down. Shares outstanding in 2022, 1.16 billion. Shares outstanding right now, 1.1 billion. I believe I read that they are down to 1.083 billion shares. So they've been buying back a lot of shares. I'm talking, 4 or 5, maybe more percent a year. So, I mean, when you look at this, 1.16 billion a year ago, now they have 1.08. So they're buying back like 7-8% a year in terms of buybacks. So their earnings per share can get propped up just by them not even growing, just by them buying back shares. And they can buy back a lot. They have a decent amount of cash. You can see about 11 billion. They are free cash flow positive as well. And you might be saying, well, yeah, they have 11 billion in cash, but they have 10.4 billion in debt. So I did a little bit more research as to what this debt is. Basically, they're just taking advantage of low interest rates. Back in 2019, this was a really good move. They offered $5 billion in aggregate principal amount of senior notes, $1 billion aggregate principal about at an amount of 2.2%. So they got interest rates of 2.2% due in 2022. So this is already done. They've repaid this or extended it. 1.25, 2.4% due in 2024. 1.25 billion rate of 2.65 due in 2026, and 1.5 billion at a 2.85 interest rate due 2029. And then they did another one back in 2020. They offered another 4 billion. Let's just look at the rates here. 1.35%, 1.6%, $1 billion at 2.3% due in 2030, so long ways off, and then $1 billion due in 2050 at 3.25%. They essentially got they did get a 30-year loan at a 3.25%. They basically got a $1 billion mortgage, which is super cheap debt. That's really good because they can pay that back at any point. All these rates too, all these interest rates that they locked in are below what they get just in yield in a treasury bond right now. So this is just fantastic for them. Then they did another round in 2022. These are still relatively low compared to today's rates. They did another $3 billion in debt. They got a 3.9% rate, a 4.4% rate, a 5.05% rate, and a 5.25%. Another 40-year loan here. If I could get a 40-year loan for 5% or 3%, I would do that. And I do. I have a mortgage and I'm not paying it off early because we're going to be able to make a lot more money from issuing debt like this and using it to grow our businesses or to invest somewhere else. It's, I think, a really good move that they did this. They basically just took a lot of cash at low interest rates and yeah, they can reinvest it, make much more money. They've also laid off employees, which some people don't like that. If you haven't been in the market very long, maybe you think that is a negative sign, but I think this is actually good. PayPal is laying off 2,500 employees, and I'm sorry for the employees, that's not good. Sorry that you lost your job, but for the company as an owner, this is good. If you can still run pretty well, this is a decent amount of the company. Their entire company has about 30,000 employees, so they laid off 8%, 9% of the company, which will decrease their expenses a decent amount. That's one thing that I pay attention to is stock-based compensation and just compensation in general. But stock-based adjusted free cash flow per share is much lower than free cash flow per share. You can see it here. They do spend a decent amount of their free cash flow by issuing more shares, paying out employees. And you might not know really what that means, but basically they just issue more shares, which a lot of companies don't count as an expense, but it kind of is because they're using their free cash flow to basically go buy back more shares. But if they issue more shares, then it basically cancels out some of their free cash flow. And you can see the last year, from 2021 to 2022, their stock-based compensation has gone down, which is a positive sign. They're tightening the belt. They're becoming more efficient. They're becoming more lean at the same time that they're hitting record revenues and earnings per share. So I think this is all pretty good. I don't see a ton of downside from here. Like, it could always fall further, but if it does, they're just going to continue to use their underlying business to buy back their shares for cheaper and cheaper amounts. And I see this kind of as I see the stock falling down because they gave weak guidance, but again, they're kind of softballing that, and they're still showing growth. They're actually re-accelerating growth. So in a time where there's not a lot of cheap options in the market, I see this as a cheap stock. It is a cheap stock, no matter how you look at it. A 10.5 PE ratio, and I say 10.5 because it's going to be lower than that when it opens. It's going to be lower than $63. 10.5 PE ratio is cheap. It's just a question of whether it is a dying company or just a stagnant company for a little while. And it's not like this ever had super explosive growth, at least recently. Like, yes, 20% growth is really good. That's about what they've had, though. Like, even 2020 to 2021, when some companies grew by 50%, 100%, they still got like a 20% growth, which is great. But it's not like they went from a 60% growing company to a 10%. No. They went from like a 15 to 20%, down to a 7%, then now they're back up at 9%. So they're still growing, they're cutting costs, they're becoming lean and mean. And I see this just as like I said, a cheaper stock. And if they can start growing again and increasing their free cash flow, increasing their earnings per share, revenue, and it's actually reaccelerating, I think this could easily move back up significantly. Now, some other people have talked about this stock too. Jeremy from Financial Education is probably the biggest bull, or the most well-known bull, and he gives some of the points right here. Like, they are having transaction growth. They're having 9% revenue growth. Their net income is up 60% year over year. Innovation hits 2024. They have some new products or something. Costs coming down 9%, or they're having layoffs of 9%. So cost is coming down. Dirt cheap valuation, conservative guide, new CFO, CEO, sounding laser focused, more transparent than ever, showing some data that they don't typically show to get more behind the scenes. So I told the Patreon today I am buying. I think it's cheap. I'm going to buy. I bought a decent amount today. I'm going to continue to buy into the future, most likely, if it stays pretty cheap. And I'm not telling you to buy. I'm not telling you that at all. You might also be saying, well, why would you buy something like this? Maybe it has 50% or 100% upside, but Bitcoin has 5x upside or something like that. I treat crypto and I treat stocks very differently. I realize that crypto is probably going to be more explosive, but also they're bigger drawdowns. There's more volatility. I don't want all of my net worth in one asset. As much as we hate to think about it, crypto could fall down 80%, 90%, and I don't want all my net worth in one asset. I want some diversified into stocks. I want some diversified into crypto. I want some in real estate. I want some in cash to take advantage. And I think that just helps me, even if it, like when you break down the numbers, it's not the most optimal way of investing. I am at a point where I want to protect downside. That is a big part of investing, is protecting downside. And I want to make sure my family's taken care of, even if it's just my own psychology. I could screw it up if I'm all invested into one asset. I would be thinking about it all the time. I'd be watching it like a hawk. So I realize that I can't personally do that, even if it is the best thing to do from a numbers perspective. I need to stay diversified. Let me know your thoughts on all this underneath the video. I appreciate you watching. Let me know if you want me to break down more stocks, and I'll see you in the next video.